Hello, Nolan, you good-looking devil, you.
Hi, Rusty. Are you muted?
Am I the first one on?
All right, good afternoon. Thank you for joining us in East Central Indiana. Thank you for joining us for the East Central Indiana Virtual Seminar. I'm Nolan Sampson, the Business Development Director for the Halderman Companies. I'd like to welcome you to our seminar that the Farm Service Agency, Nancy Best, will be speaking to some of the programs they have offered this year. And Howard's going to give an ag update. At this time, I'd like the reps to unmute themselves and introduce themselves.
I'm Lauren Peacock, and this is Chris Peacock, and we represent East Central Indiana and West Central Ohio for Halderman Companies.
Yeah, Craig Springmeyer in Eaton, Ohio, and I'm in the West Central Ohio and Eastern Indiana section.
Hey guys, it's Rusty Harmeyer. I'm in East Central Indiana, covering for the most part Wayne, Fayette, and Henry Rush counties.
All right, I think that covers all of our reps. I think at this time we're going to have Howard share his screen and start his presentation.
Good afternoon. I'm Howard Halderman, and welcome this afternoon to our seminar. And as you probably have dealt with across a myriad of meetings, everyone's had the opportunity to deal with various forms of technology and therefore technological hitches or get along and those sorts of things. So we appreciate your attendance this afternoon, wherever you might be, and your interest in this topic, which is largely agriculture in general and farmland more specifically. The Halderman Companies, in conjunction with the Farm Service Agency, are excited to bring you this information here this afternoon. And hopefully, if this stimulates any questions, you can enter those through the chat box. Nolan will be monitoring those and be glad to make sure all the questions get answered as we go through this afternoon. So I would encourage you to send them in at the time you think of the question. Go ahead and hit the chat feature at the bottom of the screen on Zoom, and then you can get that posted with Nolan, and we can get that answered in a timely fashion. So with that, as you can see in this next slide, really my first slide after the cover page, so to speak, is just who is Halderman. And my grandfather started our business 91 years ago, and that's Howard Halderman there in the middle. I'm third generation owner of the Halderman Companies today. We've been around 91 years. We're going to be around 91 more, and have always been representing landowners. And so if you have a problem with your farmland, not necessarily even a problem, but you have a need related to farmland, those services, that's what we do. We do farm appraisals, we do property farm management, and we do farm real estate brokerage. And you can see in the middle of this paragraph all the different kinds of landowners we represent. I would say a majority of our clients are going to be individual landowners like many of you. But some of our clients are trust officers at banks. Others are large corporations who own farmland as part of their holdings. And so we work for a very diverse set of people, and just very thankful for and blessed with the opportunity to represent so many different people across the US and across the world. And as the bottom of the slide says, we've been doing this for 3 generations. So I mentioned our 3 services: farm management, that's about 240,000 acres in 19 states. And we have the real estate side of our business, Halderman Real Estate Services. You see those ads out and about. And that's roughly 100 million, 110 million in sales annually. And then we did over 900 appraisals last year. That's an all-time record for the Halderman Companies. And I just mentioned that because you might have noted that the residential real estate market was extremely strong this year. Demand for loans to finance those purchases was also up, largely due to low interest rates. And so farmland benefited from some of that uplift in low interest rates. A lot of farmers, landowners took advantage of that opportunity to refinance your mortgage. So a little plug, if you didn't do that and you do have money borrowed on your land, it might be a good time to think about entering into some kind of lower interest rate mortgage or product, just because they're as low as they've ever been. And we'll cover that here in a minute. And so you can see a picture of our team a few years ago, but really we've got 23 area representatives like Rusty, Craig, Chris, and Lauren. They're spread throughout Indiana, Ohio, Michigan, and Arkansas. We've got 11 support staff like Nolan and myself that work out of the Wabash office. And the average tenure of our staff is more than 20 years. You might note that myself, Chris, Craig aren't maybe, on the younger side of average. And so we have been around a while. You can see these guys laughing now. But that's the benefit to you, the landowner. Average tenure of staff greater than 20 years. That enables us to know that land market in your area. We know the farmers, we know the people that are active and involved, and therefore we can do a better job managing, appraising, or selling your farm. And then you can see the coverage area, and we work in 19 different states. So not only do we know corn and soybeans here in central Indiana, east central Indiana specifically, but we also know and have experience with a whole host of crops all across the United States. So with that, we'll talk about farmland. And my title here says value strengthening, and that is certainly the theme that I think you're going to get from today. We saw farmland last year. I think the Federal Reserve Bank showed an increase in Indiana of over 5% in farmland values. And I would suggest to you that that strength is going to continue based on the current environment with commodity prices and depending on what kind of yields we generate from the 21 crop. So let's talk a little bit about why that market is what it is. And to start with, we have had very few outside drivers of farmland sales for the last 8 years. So go back to August to December of 2012. We sold a lot of farms, and I don't know that anybody necessarily recalls that, but basically from August through December, we had 3-4 auctions a week. Everybody was motivated to push their sales into the front end of the sales season that year because there was a fear of capital gains tax increasing. And that was when Mr. Obama it was kind of a foregone conclusion. He was going to be reelected, and we were anticipating more of a Democratic Congress, maybe similar to today's times. And so as a result, there was a fear that capital gains taxes would go up. And they didn't. I mean, at the end of the day, they never changed. But the fear drove a lot of farmland sales early. So when I talk about an outside driver, tax law change is a historic outside driver of farmland sales. And honestly, there haven't been any tax law changes that would cause people to sell farmland. Certainly, we've had tax law changes, but nothing that would motivate people to sell. Likewise, no big changes in the Farm Bill, no big trade. Yes, there have been trade changes, but nothing that would impact or cause people to want to sell. So that's been low. As a result, number of farmland for sale remains below normal, and especially for large tracts of farmland. We have seen very few, and I would say January of 21 is about as low as we've seen, except for late April, May, and June of this past year during the COVID time period when it really took off. So that remains below normal. Cropland values, stable for the last 5 years. Now, question mark, you're starting to see those values increase. And due to the better incomes and the government support that we've experienced over the last couple of years. Recreational, timber, and rural residential values. So I get it. In East Central Indiana, it's not all about cropland. You do have that other land out there, be it a creek, be it pasture land, be it woods. And those values tend to trade more in accordance with the general economy. And while the general economy certainly went through a recession back in the spring, one of the things that was that happened as a result of COVID was this demand for people to be more out into the countryside, either to live or to recreate. And that really has spurred those values to continue to move higher throughout this time period. Low interest rates also helps that as well. So we probably have had more demand for rural residential homes and things over the last year, very similar to what's been experienced in suburban areas as well. So here's the 7th district of the Chicago Federal Reserve Bank. And they do a survey on a quarterly basis, and this is the most recent. And I did check yesterday, and they have not come out with their basically the new report for January yet. But you can see here the percent change in farmland values from October to October, and that's where Indiana was up 6%. Now the other I states not so much. You know, Illinois was up 2%, Iowa up 1%, and Wisconsin up 3%. So the district as a whole was up 2%, but that I think really indicates some nice strength during a pretty tumultuous time period here in the United States for a whole host of reasons, COVID, election, and other things. So farmland, as most of you know, you're farmland owners. Farmland is a storehouse of wealth. It is a consistent returning asset, and it doesn't find itself subjected to the volatility that you might experience in other asset classes like stocks. So here's the Purdue survey. We start with the Federal Reserve Bank of Chicago. Now we're going to move to the Purdue survey, which is more local. This is Indiana specific. Blue line is the top producing cropland, the green line average, and the red below average. And you can see down at the bottom of this slide how many bushels per acre of corn each of those picks. But basically you see the peak there in 2013, following the commodity price run up of the late 2000s, early 2010s. And then the sell-off, so to speak, a little bit of a decline, 15, 20% on average across the Corn Belt that we experienced in 2014 and 15. And then we've been in this sideways channel for the last 5 years with a little bit of uptick here toward the end. So farmland has already experienced a little bit of a recession, and now we're back into what I would call a pretty sustainable long-term pattern. And really the question each year that I've done these meetings, the last 5 years, has been, all right, what's going to make us change from this sideways pattern? And, you know, we didn't see anything. There wasn't really any black swan event until COVID hit. And while that might have been thought to be a negative, it really was not in the farmland value space. So obviously stock market returned back to levels above where it was a year ago. But farmland really never moved, didn't have a down move, and it just continued to strengthen throughout the year. So one of the ways that we analyze our sales, so we started with the Chicago Federal Reserve Bank, and that's like a 5-state area. And then we moved to Indiana. Now we're going to talk about Halderman specific sales. And these are sales that we conducted. And we take the price per acre of the cropland, and we divide that by the productivity index of the soils in that field. And it's called the Weighted Average Productivity Index, or WAPI for short. You know, everybody, an acronym. And so in 2013, what this slide shows you, a lot of volatility. That's going to be normal. A lot of different property types and locations factor into that. But the trend line, that red line, is really the line to look at. And you can see that the dollars per corn bushel of productivity index throughout the year was right above $60 back in 2013. If you recall the Purdue chart, that was the all-time high, right? So keep that $60 level in mind as we look at 2014. And we started the beginning of 2014 above $60, but we ended in the mid-50s. And so that was that start of that downtrend that you saw. Get to 2015, it was interesting. Renewed hope with the beginning of a new year. And so we go back above $60, a WAPI point, but we end the year almost at $49. So if you had a year to say, where was that big decline, that 15, 20% decline, that was 2015. And then, as I mentioned, 5 years of stability. And if you want to talk about an asset that just holds its value, this is the epitome of that. So look at 2016, that red line's right about $49 all year. 2017, we start at 48 and we end at 52. 2018, again, another year of 49 all the way across. And 2019 started a little weaker, and then we peaked at over $50 at the end of the year. And then we look at 2020. So it started low. You can see that little, blip below the trend line there in Q3. But as we end the year on a lot of strength, and that's pretty synonymous with what the Purdue survey and the Chicago Federal Reserve Bank surveys show. And that's been our experience, is that there's been pretty good demand for farmland out there. And keep in mind, one of the factors is that limited supply. not a lot for sale, quite a bit of demand, and therefore you get stronger values. So here's that sideways channel that we've been in, and you can see it rising a little bit above 50 now at the end. And that just recently occurred with the sales there at the end of 2020, driving that higher. We have yet to have an auction in 2021, so I don't have any data points from auctions to put in there. I know we're negotiating some private transactions right now, and those will soon go into this number, but we don't have any 21 numbers in this chart as yet. So here's another way to look at it, and this is just a bar graph of the same information, and you can see back there in 2013 we were over $60, and now got into that sideways channel. 2016, 17, 18, 19, they all look about the same, and then moving a tick up in 2020. So one way you can kind of follow us and know what we're doing, stay up to date on the latest listings and sales that we're doing, is our just released app. It came out last fall, late in the fall, been approved by both Google and Apple. So if you go to the App Store and look under Halderman Real Estate, you'll find that, and you'll be able to track not only what we have upcoming, it has a map feature, so if you want to look in your area, what do we have for sale? I can tell you the listings are pretty light right now. That's consistent across the Corn Belt. I talked to a very large real estate broker in Des Moines today, and yeah, in Iowa, he confirmed there's just not much for sale even out there. So that's a consistent theme. So one of the things I did, now this information, I'm going to pick on Craig and Chris and Rusty because they contributed to this survey. And I think they probably would want to retract their statements. So look at the timing of this. This survey was done in early September. So remember, commodity prices were not as glowing in early September as they are now. And I asked all of our staff, Lauren, Chris, Craig, Rusty, Nolan, what do you think farmland values, what do you think woodland values, rural residences are going to do over the last year? And so you can see kind of a 50-50 split on the best crop land. A few people thought it was stronger, a few people thought it was weaker. Likewise, average crop land, maybe a little more on the weaker side. Woodland, stronger, and certainly rural building sites and residences were quite a bit up. And then livestock is weaker, and livestock has had a tough time. We're talking largely dairy, cattle, and pigs when we talk about those livestock facilities. So this was their opinion of those farmland values from 19 to 20, September to September. So just kind of an interesting thought, pretty sideways, like many of the charts have shown. I asked, this is actual dominant purchasers through the end of 2020, who bought a majority of our farms? And that's always an interesting thing. I get a lot of people asking me, well, who buys the farms out there today? It's still a majority farmers. 60% bought farms at our sales, private or auction, this past year. We track that with every closing that we do. It got to 66% in 19, 67 in 15. Now, I would argue that you'll probably see that number, the orange part of that bar, expand a little bit, because if farmland investors may be attracted due to the higher commodity prices. So number of sales compared to previous years, and this is just a question I asked him. What are you seeing out in your marketplace? How many sales? And you can see 75% of the respondents thought they were seeing fewer sales than they saw a year ago. Again, tight market. Dominant purchasers in the marketplace, 70% said farmers. Now, why is that number different than the slide 2 slides ago? So in our sales, we show 60% being purchased by farmer. But if I go back in the survey, 70% purchased by farmer. That's because in this question, it's inclusive of the entire marketplace. And you have some transactions that occur out there that are from landowner to tenant, and there's no broker involved. And that's a farmer buyer. So that's why that number would be a little bit higher. The interesting thing is when I see surveys like this done by Iowa State University or the University of Illinois, that 70–80% farmer buyer is a consistent number across the Corn Belt. So we are certainly not unusual here in the Eastern Corn Belt. The one interesting factor is that recreational popped in at 5%. That's a little higher than what it has been in the past. One of the things that you can watch, and I would suggest that if you wanted to go online and look this up, the Purdue Center for Commercial Agriculture, in conjunction with the CME Group, they do this ag barometer every month. And you can see it going back to when it started in 2015. It's a 0 to 200 point index, and they ask 400 farmers, producers from around the United States, not just Indiana, all over the country. What do you think about agriculture today? And they ask a whole host of questions, and they ask about future thoughts, will you buy more farmland, or how do you feel today versus what do you think about the future? This is the today feeling barometer. And if it's just always interesting to look at this. Back when Mr. Trump was elected, you can see the jump from around 100 all the way to 132. During the 4 years that he's been in office, a pretty consistent 125 was the average of the ag barometer, which again is above average in terms of how you feel about agriculture. And then you see it crater. Well, what was that? That was COVID. So the COVID impact was significant, took us down below 100 briefly. But then pretty quickly, some of the payments, the CPAP payments that came out, combined with starting higher commodity prices into the summer. And you can see that escalation of that barometer going all the way up to 170, above 175 2 months ago. So that is usually how somebody feels about the current state of agriculture. And that does translate into rents, and that does translate into values, because what you'll find is a lot of those people will say, if I feel better about the future of agriculture, I'm willing to pay more for rent, for land values. So typically we will see this mirror our sales results as we go through the year. Thankfully, we had very few for sale back in the May time period when that low number was registered. So let's talk a little bit about farmland debt. That's always something to keep your eye on, and it is creeping up. And so when you look at this chart, this is the real debt, U.S. farm sector, and it is going back to 1960, and you can see the peak there in 1980, where non-real estate and real estate debt was at the all-time high. Now this is inflation adjusted. If you didn't take inflation out of this, the number today would be much higher in nominal terms. But inflation adjusted, we're back to about the all-time high in terms of total real debt. Now that would be concerning, except for a couple of other factors. Now, look, non-real estate debt is not near as high as it was back in the 1980s. That would mean that we have less debt on tractors and operating lines and more just on real estate. So that's probably a positive factor. So here's the difference. Debt's about the same, but the interest rate is dramatically different than what we experienced back then. And the interest expense is that orange, red line, depending on your version of that color and mine. Farm sector debt is shown here, and you can see the peak in 80 and then the coming back up to that level today. But look at the interest expense. In the 1980s, we were looking at double-digit interest rates, and today we're well into the low single digits. And so as a result, that interest expense, which helps the federal government, oh, by the way, balance its budget, it also lowers the interest costs for farm operating lines and for farm mortgages. And I think that's a significant factor. And the beauty of it is, I mentioned a few minutes ago, fix your interest rates or look at fixing your interest rates if you haven't already done that. Back in the 1980s, a lot of those loans were variable rate loans. And so they floated to the 15% and those astronomically high numbers. If we're fixing these in at this low rate, these low rates today, even if interest rates do move up with inflation over the next couple of years, we're not going to be as impacted as what we were back in 1980, 81. Here's another way to look at farm debt, and that's the solvency ratio. So if debt is about the same, inflation adjusted, what's interesting is your debt to equity and debt to asset ratios are much less. Well, why would that be? That's because farmland values have not fallen like they did into 84, 85, 86. And back in those days, we lost 60% of the value in farmland. And we haven't experienced that. Yeah, it went down 15, 20%, but then it's hung in there pretty consistently and now maybe trending upwards. So your debt to equity, debt to asset ratio, while it's come up a little bit the last few years due to that decline, is still at a very healthy ratio today. Now, debt to income, just another way to look at debt. And this is kind of an early warning metric in my mind. So if you go back to 1976, 77, when you go above 5 on this debt to income, so that's debt divided by income ratio, that becomes a warning sign that maybe we're getting into some risky territory. And certainly back in 76, we went above that. And you'd say, well, Howard, the farm crisis didn't start till 1981, 5 years later. That's why I said this is an early warning signal. So if you go back to 2016, we saw that ratio go all the way to 6. And there was some concerns in the agricultural sectors. Ooh, we're well above 5. Is this going to be another repeat of 1980? The last 4 or 5 years since that time period, the trend has been downward. And certainly as incomes went up in 2020, that ratio is now down to a 4.2. So not a huge early warning at this point in time, but that's another ratio to look at. Share of farm real estate loans delinquent. I just put this up here to ease your mind that if you go back all the way to 1987, where it was above 3.5%, look at the trend line, somewhere around 2.3% of all farm loans are delinquent, and we're just now back to that in 2019. I would imagine in 2020, that number, that yellow line may drop down a little bit. Share of non-real estate loans delinquent, farm related though, so equipment, operating lines, you can see that's right back to the 2.2 type of percentage. So very small percentages and really historically pretty normal. Volume of delinquent farm loans, just total billions of dollars, and you can see we've gotten back to that level that we experienced in the recession of 2009. And again, not at a concerning level at all. Now here is one that is concerning. And I've talked about this the last 4 or 5 years as being that bellwether that really could cause a problem if we got into really tough income times. So this working capital, and you can see back in 12, we had almost 40% working capital. That's a big number. That means you've got a lot of cash on hand. And that cash has been eroded, especially 2014, 13, 14, and 15. We saw that cash kind of get taken away with lower commodity prices. Then we've been pretty static with a decline here at the end. Now, when 2020 gets all said and done, if you factor in the support payments that we received and the higher commodity prices right at year end, I bet that working capital ratio jumps probably closer to 20% when they get the final numbers put together. And 21 will probably be a jump back up as well due to the better income this past year. Here's real working capital, and this is in billions of dollars, and just another way to look at that working capital number and where it was back in 2009, 10, 11, and 12, and where we are today. And that's why that one ends up being a concern. Bankruptcies, that's always something to watch. This, again, could be a kind of that canary in a coal mine. Well, back in 2008, let's start with the story and why I even put this on here. I read a headline in 2018. Chapter 12 filings are double what they were in 2008. And I sat there thinking for a second, oh, that's concerning. And then I thought, well, wait a minute, 2008 wasn't that bad a year in agriculture. So what are they talking about? Well, I went back and looked, and in 2008, Chapter 12 filings were about 250 across the entire United States. Keep that in mind, across the whole US, not just Indiana. Yes, they were double in 2018 at 498. And in fact, 2019 through March of 2020, Chapter 12 filings went up to 627, a 23% increase over the previous year. So that seems like a bigger number, right? Until you compare it to 1987. And that was almost 6,000 Chapter 12 filings. So, okay, we're above 10% of what we were in 1987. The number is increasing. That's a concern. But I want you to keep that in perspective when you think back to the 1980s. So farmland, where do values go from here? And it depends on these 3 things. And it has always depended on these 3 things, really. There are other minor factors, but these are the major ones. Farm incomes. Why did we see farmland values go up in 2020? The government support combined with better commodity prices and pretty good yields. Those 3 factors created some pretty good farm incomes in 2020. Therefore, farmland values are a little stronger. Layer on top of that, pretty low interest rates that have declined, and that's a more bullish factor too. And then we come into this December, January time period of almost nothing for sale. That low supply is also bullish. So when I conclude today, you're going to hear me say I would predict farmland goes up 5% in 2021. That's not rocket science. That's looking at these 3 major factors and saying, yeah, those are all pretty favorable today. The incomes from 07 to 13, we talked about that. You saw the working capital chart. That's where a lot of cash was generated. 14 to 19 was a cash drain. You saw that also on the chart. Government support, don't miss it. That's been absolutely critical. The trade and market facilitation payments that we received in 2018 and 2019 were hugely helpful on the income side. And then the COVID support payments that we received in 2020, those are all shoring up our farm incomes. And I've got a couple slides on government supports just to provide the evidence on that, but it's pretty critical. Interest rates still historically low, and the farms for sale, the supply of farms for sale remains below normal. So let's talk about farm incomes first. You can see here that I put that at $700 to $1,000 an acre gross. And you say $1,000 an acre, what are you growing? Well, 200 bushel corn times $5 is $1,000 an acre gross. Well, okay, Howard, you're not at $5 for 2021 crop. No, we're not. But 225 bushel corn, and yes, there are farmers that are in farms that produce that, times 4 something generates $1,000 an acre gross. So could we get there? We could, especially with the government support program payments added in. But farm incomes have trended up a little bit. Total production costs, and this is coming from my staff, basically $700 to $740 on corn, including rent, and $300 to $550 on soybeans. A lot of variability there. I'd probably put it more generally toward the higher end of that range. So you can kind of look at where corn and beans break evens are, including rent. And when we get to incomes that are $800, which is $4 times 200, we're profitable. And so that's why I've been an advocate for the last couple of months when we've been above $4 corn. You need to be clipping some coupons on these, maybe leaving yourself upside potential via some options, but taking some chips off the table at a profitable price is never a bad decision. So you can see we're above break even today, and we're above break even for last year's crop, and the opportunity exists to sell next year's crop, the 21 crop, at a profitable level. So again, talking about farm incomes, it's pretty optimistic as we sit here on January 19th. As a result, we do see demand higher for rents across the Corn Belt. Now, this one's a little blurry, I think, farm incomes. This slide, if you'd have looked at it 3 months ago, did not have the tail at the end, the big upward trend at the end. But you can see we're back up to $134 billion of income, net cash farm income this year. And that's starting to get back close to those numbers that we saw in 11, 12, and 13. So again, just across USDA documenting that same increase in program payments. So we talked about government payments being critical to the producer these past couple of years. This is real. So this is taking inflation out of the equation. What are the government payments being paid to farmers? And yes, in 2020, it's the all-time high, even adjusting inflation out of it. So you can go back to the PIC programs of the early 1980s, set-asides in the middle 80s, support there around 2000 with Freedom to Farm. And yet this past year was the all-time high. When you add in the ARC and PLC programs on top of then the COVID offset and trade offset payments. So pretty helpful. The farm income and direct payment comparison. So net farm income, the orange part of that are the direct payments. So you can see the last 2 or 3 years how important the direct payments have been, and especially there in 2020. So we're up quite a bit in farm incomes, over $100 billion, largely due to the direct payments. And then here's just another chart taken, if you take net cash farm income less the government program payments adjusted for inflation. And prior to that run up right at year end on commodity prices, it was a downward trend. Now that blue bar for 2020 probably ends the year a little higher than when this was published, but still that's a downward trend in net farm income if you didn't have the government program payments. Now, I mentioned earlier that I get it that East Central Indiana isn't just all about cropland. There are a lot of other types of land, especially hardwood timber land. And hardwood timber is a valuable resource in Ohio and Indiana. And so I just pulled this out. This came out in the Woodland Steward newsletter that I receive. It's done here in the state of Indiana. And they do a survey every year of all timber sales by foresters, consulting foresters across the state. And they report on average stumpage price per year and then a median stumpage price per year. And I'm not going to get into mathematical descriptions here, but basically you can kind of see the trend. And in spite of tariffs, that price has actually worked its way higher the last few years. But in 2020, it did experience a slight decline. And you can see total number of sales also decline. That's the purple line in the top chart. So as I was reading the articles on this, really some of the hardwoods are experiencing some lower prices, largely due to the fact that the trade wars have hurt them going into some of our Southeast Asian markets. But still higher than what it was if you go back 10 years. Here's the cap rate on farmland today. And you'd say, well, why is this important to me? Well, if you're comparing farmland to other asset classes, namely CDs or bonds or treasuries, the 3% cap rate is a pretty positive number. Now that's a gross. Net's going to be probably 250 to 275, but still well above what you can get in those other similar fixed income assets. So farmland leases, we're going to talk a little bit about that. I'm sure there's someone here wondering what's happening out there. Certainly in agriculture, we see a lot of consolidation. Well known in livestock. That happened, that ship has sailed and did so a number of years ago. Consolidation in grains continues. So if you compare 2002 to 2017, you saw a drop of 1.5% in the number of farms producing 75% of the total sales. So what does that mean? Basically, farms got bigger. And farms producing 75% of the sales own 37% of the equipment. Now I put after that. What does that mean? That means that we are, and we've known this for years, we're overcapitalized in agriculture. Most farmers own more machinery than what they really need, except when you run into the spring of 2019, and it rains every day, and you have to get that crop out quickly. Then you don't have enough equipment. But in general, that's what that number, those metrics would say. I did put an organics comment in here. The 374 largest farms in the US, 43 of them had organic sales of some sort. So what that's telling you is over 10% of the farms out there, the largest farms, are into organic production. Just something to think about. And then finally, scale. You know, what is the benefit of scale in agriculture? Yes, I can buy my seed cheaper, or I can buy my fertilizer or pesticides cheaper. Farms producing 75% of the sales, those largest growers, did so on only 69% of the expenses. So there is some benefit to size. Cash rents were results. So now, again, I asked this back on September 1st. I think they would answer differently today. Results of the 21 cash rents, basically it was a steady opinion back there in early September. That's usually ahead of a lot of our rent negotiations. So to be fair, not a lot of them had negotiated rents at that point in time. Would you lower cash rents? And back then, 7% out of the 19 said they would lower cash rents. I think that number would probably be less today, just because we've seen the big run up in commodity prices since harvest concluded. Demand. Now, this back in early September, more demand. The same, 9 people said the same and 10 said more. So you see that's the amount of land for rent. So that's supply. So the feeling was back then that we would see more land for rent on the marketplace. Demand was going to largely be the same, maybe a little less. Again, I still think that's changed. Our opinion since September 1st to January 1st would be a lot different. Although a lot of leases probably got done in that November time period before commodity prices got as high as they have the last 2-3 weeks. Defaults, again, one of the benefits to owning farmland is 100% of the acres get leased. So you have a 0 vacancy rate, and it almost 100% don't have any defaults on leases either. When you compare that to the commercial space or strip malls or something like that, farmland compares extremely favorably because of their long-term nature of the tenancy and the strength of the tenants that exist out there. But you can see back there in early September, we didn't expect anybody to default on a lease. We thought maybe some would give up a lease. Again, I bet that number's less today. I bet there would be fewer guys that would say, yeah, I doubt I have a tenant be willing to give up a lease at this point in time due to the income prospects for 2021. Cash flex leases, would you try to implement any more of those? And largely they said no, because a large share of our cash rent leases are cash flex already. Why is that a benefit? Well, when you get into a good agricultural year, like we experienced in 20, a cash flex lease ends up being a fair way to share additional income with the landowner. Now, you're not giving up 100% of all your dollars over a certain number. You're only giving up 25 or 33%. But it does give that upside potential of a bonus to that landowner, helps retain the farm long term. And maybe there's a bonus paid in 21 if we have good yields and prices stay high. Maybe not. Who knows? We might have another black swan event that would cause lower prices. And so as a result, the cash flex lease, I think, is a very fair way to lease a farm today. So when we do that, we set a base gross revenue number somewhere, and you can see in this chart $636 to $750 an acre for corn, including rent, and then $450 to $550 for soybeans. So that first $750 in corn goes to the tenant. He pays his rent out of that, the guaranteed rent to the landowner. He pays all of his expenses, and he makes hopefully some degree of profit off of that. And then every dollar over $750 is shared with the landowner. And again, as I said earlier, 25 or 33% going to the landowner and the lion's share of it going to the tenant. So that's the way that works. And you can see the base cash rents range anywhere from 200 to 250, the last point on this slide. It's about 90% of what the fixed rent would be in the area. So it's less risk for the tenant on the front end. And then they give up some potential for a bonus on the back end if it's a good year. And here's the Purdue chart on cash rents. And you can see through 2020 that we've been in that same sideways channel, kind of like values have been. Again, I said farm incomes drive values. And nice uptick here into 2020. I would imagine we'll see another one. The survey's done in June. And so by the time we get to June of 21, we could see that increase again for 2021 cash rents. Here's the USDA survey. So this is all the rents across the entire United States. So therefore lower levels than what much of East Central Indiana would rent for, but it's an average. And so it just gives you an idea of the trend, peaking in 15, dropping in 16, and then trending back upwards since that time period. Again, mirroring farmland values. So where do we go from here as we start to look at wrapping this up? When you think about farmland as an investment, it's a long-term investment. It's not something you buy today and you're going to sell in 3 months. And one of the factors is this long-term world demand fundamentals. They remain bullish for agriculture and therefore prices. Look in China, look at what African swine fever did to the swine herd over there. Cut it in half. That effectively cut 25% of the pigs in the world because of half the pigs are in China. And that has been increasing this past year. So why is China demanding more corn and soybeans? Well, that's one of the reasons, because they're expanding their swine herd. That goes to feed their people. And so when you think about world demand fundamentals remaining bullish, that's an example. Just-in-time delivery does have impact. You know, we have run on this just-in-time mentality with not having a lot of excess commodities in storage here in the United States or across the world. So when all of a sudden we see significant growth in demand from China, combined with maybe some lower yields from the derecho event, combined with prevent plant the year before, all of a sudden we get into very tight stocks and therefore higher commodity prices. So that's one factor. Interest rates still favorable. I put this in here, 4.24% is the average real estate mortgage rate, fixed rate for 15 years. That's the lowest in the recorded history of the 7th district doing the survey. So think about that. That's pretty cheap money, folks. And that's for fixed dollars. Supply of farms for sale remains low and lower for right now. How long? Who knows? You know, what could be one of those change factors? Oh, capital gains taxes going up. You know, and that is something that certainly has been talked about by the Biden administration. So as you start to think about the first 100 days that start tomorrow, tax law and tax law proposals and those kind of discussions become pretty important to farm landowners and those impacts. And then government support in 21, also going to be talked about. The annual programs aren't going to change. The Farm Bill is going to remain in place. The question is, are we going to get any kind of supplemental support? And certainly they're talking about additional support due to COVID. How does that spill over into ag in some fashion? Maybe with the higher commodity prices, they're not so excited about it, or Congress isn't. And so my question here is cash increasing? And I would argue that it probably is. Cropland values are in an uptrend, as we've talked about multiple times this afternoon. I still see strength in the timber, recreational, rural residential markets. There's still good demand. A lot of people still looking to live out in the country. They've figured out that work from home works for a lot of different professions. And maybe they want to live out in the countryside and they don't have to live in a city. So I still think there's pretty good demand on those. That average to below average farmland, you would look and say, well, the overall market's up 5%. My below average farm in 5 fields should also move up 5%. It might not, just because of the efficiency factor or inefficient factor that exists with those kind of farms. So we're in the winter of 21. I'm bullish. I'm going to tell you that right up front, and here's why. The land value bulls are going to point to profitable prices. We talked about that. Low amount of debt versus assets in agriculture. We've talked about that. Low interest rates, low supply of farms for sale. Biofuels. Okay, that's something that's a big question mark. What's the RFS going to be going forward? You'll see biofuels on my bullish slide and on my bearish slide because we don't know. Demand right now is currently low. Fuel demand is low because we're still working largely from home, not traveling as much. So that one's a little more shaky. World population growth certainly still occurring. Trade deals will help. And I think Mr. Biden is going to look at going back into the TPP. There could be some trade deals get done here over the next 6 months. But again, left to be seen. Potential for inflation. That really is an unknown. I've heard some people say we're already seeing inflation. I've seen others say, yeah, we won't see it for a couple of years. But when we do get into inflationary time periods, farmland tends to perform well, tends to be a good asset that is a hedge against inflation. And then water resources and competition, always something you need to be mindful of. We have an abundance of that usually here in the Eastern Corn Belt. So not a big deal, except it means that this is a good place to own farmland. So on that bearish side, what if, what happens with this pandemic and COVID-19 if there's a new outbreak, this variant mutation is more problematic than what people predict, the vaccine has different effects, that could come back and bite us. I'm not predicting anything there. I'm just suggesting that could have an effect on demand and prices. Weather impacts and trade, obviously that's always an unknown. Right now, I would say that look across the Corn Belt, we're relatively dry for this time of year. If you want to have a drought, not that anybody does, but if a drought was to form in the summertime, a dry winter is a good precursor to a drought. Doesn't mean it will be, but it certainly sets up for an increased potential of that. You'd be looking at some sky-high prices if that were to happen. But weather impacts and trade, and again, trade we can't predict either. Global and U.S. production is enough right now, but could we have more? Argentina's struggling with their weather currently. Brazil's having some decent weather. But could we get into global production increasing? Because that certainly happened in 2012, 13, 14 due to higher commodity prices. So one would argue that we might get that again. Worldwide economy tanks. I'm not a big proponent of thinking that's going to happen, but that certainly would lower demand. Trade agreements or not. So trade agreements work positively or negatively depending on the outcome, as do the biofuels and the RFS mandate and what the new administration's policy is going to be there. And then, interest rates increasing due to inflationary concerns. Inflation has a positive lift on farmland as an asset, but it also can have a negative impact with higher interest rates increasing the cost of interest for those mortgages that you have out there. Other asset returns, competition. Obviously, the stock market has performed really well. So does that drag continue to pull money away from real assets like farmland? We right now compare very well to liquid treasuries and CDs. If you get higher interest rates, then they become more equal. Working capital concerns, I would say that's largely over for right now. And at the end of the day, bullish fundamentals exist. We've got higher prices, higher demand for rental land, and higher land values. That's the theme sitting here in mid-January of 2021. And as we look forward to what land values might do with very little for sale and better incomes, I'm going to predict that land values will continue to be stronger. And so if you're thinking about selling, now would not be a bad time. We're not at the all-time high, but we're higher than we've been the last 5 or 6 years. And we know what current capital gains tax rates are. We don't know what they might be in 6 months or 12 months. So if you're thinking about that, that could be a reason to sell. But if you're like me and you want to own farmland because you love farmland, then I would just hang on to it because it's going to be worth more next year than what it is right now. So with that, Nolan, what questions have come in?
I don't have any questions right now.
No questions at all?
No.
Wow, okay. Well, I don't anticipate that I did that good job of explaining. So a couple of housekeeping things. This PowerPoint, I am glad to share. So if somebody sends me an email, and my email address is right here on the slide, shoot me an email or send it to Nolan and say, hey, Howard, send me the PDF of your presentation today. I'll be glad to do that. Likewise, Nolan's recording this. So if you want a recording of it emailed to you that you can share with a family member or somebody else, we're glad to do that as well. Nothing really proprietary here. This isn't rocket science. We're glad to share that information.
Perfect. Well, thank you, Howard, for that. I've listened to this several times, and I still think I pick up something new each time he talks. And if you have any questions, feel free to reach out either today or after the meeting. And with that, I think Chris is going to introduce Nancy, who's going to present on the FSA program offerings.
Yeah, I get the privilege to introduce Nancy Best this afternoon, and it truly is a privilege to introduce Nancy. Nancy's someone that I hold in very high regard. She gives her all in helping and serving the ag community, whether it's in East Central Indiana or at the state level in Indianapolis. Currently, Nancy is the County Executive Director in Randolph and Wayne counties. She has 30 years with Farm Service Agency, starting as a program technician and working her way up to Administrative Officer and even serving as the Acting State Executive Director in 2017. She came back to Randolph and Wayne counties in January of 2018 to serve as the County Executive Director in the shared management of Randolph and Wayne counties. She divides her time between the two offices today. We're very fortunate to have Nancy present for our seminar. Ladies and gentlemen, Nancy Best.
Can you hear me?
Yes.
Okay, good. I wasn't sure if I had my microphone unmuted.
Can hear you good. Have
Thank
at it.
Well, thank you for inviting me to speak with you guys today. I do appreciate it. Always nice to be doing something with a little bit different technology also. Howard shared that slide about the 2020 government programs, and I can just say we felt all of that in 2020. I had 34 years been with FSA, and it's unprecedented how much we did in that past year, and I still can't believe it with less people than we did in the past. So I felt every payment that went out. So our office offers a variety of different programs to you, and I'm just going to make some of them you may not be aware of. So I'm just going to kind of touch on some of our programs. We'll have some questions at the end. So if any of the things I went over a little too quickly, you want to talk a little bit more about, just ask your question there at the end. So next slide. So we have a conservation reserve program. We have two types of conservation reserve program. We have the continuous, and that's what I'm going to talk about first here. We are taking offers. This name says it all. We take it all the time. So these are for environmentally sensitive acreage. So right now we're taking sign up 55, and that's for any land that's not currently enrolled in CRP, or maybe that we have contracts expiring on September 30th, 2020. They can re-enroll those for another additional 10 to 15 years. But unlike general CRP, these don't have to go through a competitive process. So long as you're eligible, it meets the criteria, you can get back into the program. Some of the practices that we look at on this are grass waterways, filter strips, riparian buffers, wildlife food plots, hardwood tree plantings, those type of environmentally sensitive land practices. And these contracts can go anywhere from 10 to 15 years. Our tree practices are ones that normally go for the 15 years, and our grass practices go for 10 years. So next slide. So the general CRP sign up. We have a sign up going on right now. It started January 4th and runs through February 12th. I call this a full field sign up because this is for ground that's, like I say, those environmentally sensitive for continuous or smaller acreages. This is when you're wanting to put a full field into CRP. Doesn't have to be a full field, it can be part of it. There is a little catch on that. It does have to be eroding at a factor of 8 or greater. I can't tell you what 8 or greater is, but it's not going to be flat cropland. This is going to be a little bit more rolling. We're still looking at environmentally sensitive land when we're looking at that type of thing, but it's just a little different. So we do have some contracts that are expiring September 30th. Those can be re-enrolled possibly. This is different than continuous because this is a competitive process. So the government's looking to get the most bang for the least amount of money. So we have an environmental benefit index. So that depends on the type of practice you're putting out there. You get more points for trees, you get some more points for environmentally sensitive land and those types of things. So the more points you have, the better opportunity you have to get back into CRP. We do have a maximum payment rate for general CRP of $240, but our rates are determined based on your soil types. So a lot of times the soil types that are eligible for CRP in this general area are not going to be the 240. They're going to be a lot less on that. You know, this 240 is probably more the ground along the streams and those types of things, the really good ground. And usually this is not the really good ground that we're putting into this. So some of the practices that are eligible for that are, we have the state acres for wildlife enhancement. And the one I want to probably mention in this area is the one for trees. And we are a priority area for the Indiana brown bat habitat. So we get extra points when we put trees in there because of that. And in one of the trees that you would be planting in there is shagbark hickory. And as you know, that shagbark hickory, that bark is very, it's very loose on there. And that's a good place for the bats to hide into that bark. It kind of scares me to death, but that's a good thing for that. So another thing is that those practices can go from 10 to 15 years. The tree practices would be the ones that would be going to 15 years. Where the grass practices would be 10 years. Okay, next slide. I think Howard talked about the agricultural risk coverage and price loss coverage program, the ARC PLC. We've got a sign up going on right now till March 15th, 2021. The deadline was last year to update your PLC yields, and those updated yields are going to be starting being used for 2020 when those payments come out later on this year. We had a lot of farmers in 2019 select a multi-year contract. And so what's nice about that is that rolls over from year to year unless a change occurs. So if you do change operators, you change owners, a lot of times if we change acreage, that knocks that contract out, and then we would have to re-enroll that again. I think we have about 74% of our contracts are multi-year contracts. So that's kind of a good thing for us right now. But if you remember right, back in 2019, you had the opportunity to elect ARC PLC or ARC County, and you were locked in for 2019 and 2020. Now for 2021, 22, and 23, you can change your election each year. So even on a multi-year contract, you're not locked into that each year. We do need to have a signature on the contract. It's required for all producers who share in a crop on that farm other than CRP. Now, Purdue usually comes out with some educational tools or some suggestions what they feel would be recommend that you sign up for that. I've not seen that yet. A lot of times your crop insurance agents also have some sort of a calculation that they run through to see what's going to be the best thing there. Time is running out. March 15th may seem a long ways away, but when you've got around 1,800 contracts that might need to be changed before March 15th, and the state that our offices are in right now, it's a little scary. So that is something that we're looking for Purdue to put out. I talked to our extension agent. She said she's heard it's coming anytime soon. So that would be something, even the ones that are rolled over, you might want to think about changing it. We also had all the farms that did not roll over, or we had people that signed up to ARC Individual. Those farms will need to be selected for 2021. So we still have a lot of work ahead of us for that. So next slide. I'm going to talk a little bit about the Wildfires and Hurricanes Indemnity Program. When I first read about this, I thought, what does that have to do from anything from Indiana? Because we don't have any wildfires, we don't have any hurricanes. Well, in late 2019 or late 2019, they added excessive moisture as a qualifying loss. And we all know what happened in 2019. We had a lot of excessive moisture. So that made the Wildfires and Hurricanes program pretty big in our county. So the deadline was October 30th, 2020 to sign up for that program. All the applications in both of my counties, Randolph and Wayne County, have been completed and have received their 50% of their calculated payment. But there are a lot of offices that have not been able to get that processing done in Indiana and in those states that were really hit by the wildfires and hurricanes. They're still processing. You know, I know up to the week before last, we were helping other counties in the state get theirs done. We've been a little bit busier, so we've kind of quit doing that. So until all those applications are processed, they are not going to know if we're going to be able to pay all of the rest of that 50% payment, part of it or none of it, because they got to first see how much. It's a limited funding out there, so we got to see how much money's left over, and we won't know that until all the applications have been loaded. And so far, we've not heard about a drop dead deadline to get those loaded. Okay, next slide. We'll talk a little bit about the Coronavirus Food Assistance Program. It's the CFAP program. We did have 2 of them in the past years. The last CFAP 2 closed on December 11th, but we just heard last week about some additions to CFAP 1 and CFAP 2, and we have a sign up that started today and runs through February 26th. I don't think this is going to be a big sign up. I think this is going to be, these are going to be very specific things that are happening. Don't confuse this with what we hear about CFAP 3, this new additional program that they announced at the end of December, because right now we don't have a sign up for that yet. I've heard March on that, but that's just what I've heard. And I think I've been reading that in the news releases, just like what you guys have been seeing. These are just what we're talking about with this little short time frame, are some additions and corrections to some things that they wanted to make that would help make things a little bit more fair. But with the CFAP 3, what I would suggest is that as soon as the information becomes available about these programs, we're going to send a Gov Delivery update out or a text alert. So if you don't want to miss out on anything, you can sign up for our text alerts, and you send a text to IN Randolph to that 372-669 or IN Wayne to that same number, and you can get our text messages. You can do that for any county in the state, and then you'll get their text messages. I normally, and we can't send out more than 2 per month. Sometimes I don't send any out. So don't think that you're going to be getting a lot of text messages from me. You won't. But we do put the important deadlines in there. So if you don't want to miss a deadline, sign up for those. So next slide. I want to talk a little bit about these CFAP 1 additions. The first one is that we're going to, this is not going to open up the program for anybody that missed it the first time. It's only going to be, it's going to be doing some updates. So for that second bullet there, for the swine producers, I believe Howard was talking about how swine producers were hurt pretty badly there. We're going to make another top-up payment of $17 per head based on their inventory that they reported on that CFAP 1. There's nothing those producers have to do. We're just going to make the payment. Those payments were not in there this morning. We heard that they might be processing tonight. So there is a payment limitation of out there, but what's going to happen is if it's an entity, there's ways that they can go in there and increase their payment limitation that they may have not needed to when we did the CFAP 1 payment originally. And those entities, in fact, I just talked to one just a little few minutes ago before the call started. So we will be working with those producers. And if you ever have any questions about any of these programs on our farmers.gov CFAP 2, there's some information on the internet. So if you want to go to the next slide. This is an additional one. I know there's a lot on this slide, and I'm just going to do some highlights on it, but contract growers are normally not eligible for our programs because they don't have a share in the livestock. But they did add something in there for those, for the CFAP 2. So they said any contract growers of swine, broilers, laying hens, chicken eggs, and turkeys who suffered a drop in revenue from 2020 as compared to the 2019 are eligible now for some assistance, and they could receive 80% of that revenue loss. And we're still trying to find out how they're going to certify that to us and what they'll have to bring in. They've also added pullets and turf grad sod are now eligible for those producers who did not sign up that had that. They can now come in and do that. And there's also some adjustments to the calculation for some of these specialty crops. We looked at dollar values, Christmas trees. I think I had somebody had goats. Those are a dollar value that we're going to be making some changes on those. And but I understand that some of those people, their lobbying groups have already contacted them. They will have to come in and adjust their existing CFAP application, and they can do that before the February 26th deadline. Also, we had some producers that had crop insurance, but maybe their 2020 actual APH was not available. So in those cases there, we were using 85% of the ARC County benchmark yield. So in this case here, they're going to up that to 100% of that. And so from what I understand, those producers probably, if I remember right, the few that we had that know who they are. They will know to come in between January 19th and February 26th to update that. If they're not sure, they can have us look at it, but most of them have the paperwork to show that we did use their APH on that. So we're still working on some of the updates on this. We just had an emergency call last Friday on these updates to CFAP 1 and CFAP 2, but I just want to make you kind of aware of some of those changes. This is not the CFAP 3 sign up that is going to be coming out, sometime this year. Those details just aren't announced, but like I say, just kind of keep watching on our news releases to see what's out there on it. Next slide. Quality Loss Adjustment Program. We have a sign up that started January 6th and runs through March 5th. And this is a quality loss that provides for producers who suffered a quality loss due to natural disasters in 18 and 19. So the producers had to have an effective production, must have had at least a 5% quality loss, and that's reflected through a quality discount or for forage crops and nutrient loss. So we're looking at, for the regular crops, they're going to have to show a price loss on the settlement sheet there that they were docked. So our qualifying losses, of course, if excessive moisture is still there, we can look at that. Now, this program is going to be a little different, is that we're not going to make any payments until the application period ends, because again, it's a limited funding. I don't think they know exactly how many people this is going to affect. So they aren't going to make any payments on this whatsoever. We've had a few inquiries, but nobody's been in to sign up yet. I don't think it's going to be a big deal on this, but we'll wait and see. So let's go to the next slide. So to apply, the producers have to provide us verifiable documentation to support those quality losses or the nutrient loss. And the crops had to have been sold, the crops have been sold. The grading has to have been completed 30 days after harvest. And for forage crops, a laboratory test has to have been completed within 30 days of harvest. I don't think the producers of hay in our area get a laboratory test on their hay within 30 days of harvest. So I think we're looking at more regular crops on this. So we can take acceptable forms of documentation, complete this, include sales receipts from buyers, settlement sheets, truck and warehouse scale tickets, but it does have to show the actual and very specific quality loss information and any type of forage test for that nutrient value. Crops that are sold or fed to livestock or in storage may be eligible, but anything that was destroyed before harvest is not eligible. So I think what I've been hearing about is that we might have had vomitoxin in the wheat in 2019, and a lot of guys took a big dock at the elevator. So if they want to bring those settlement sheets in, and it's up to them to go through their settlement sheets, figure out those ones, and they can bring just the settlement sheets on those ones that have the dock. They don't have to bring all their settlement sheets, just anything that was docked on there. And if they apply for that program, they are going to have to get crop insurance the next 2 years. So next slide. I want to talk a little bit about the Farm Storage Facility Loan Program. This is a very interesting loan program, something a lot of people don't realize that we do. It is a conventional loan that will pay up to, or loan up to $500,000. Producer has to come up with a 15% down payment. We also have microloans that will go up to $50,000, and they only have to come up with a 5% down payment. There is a $100 non-refundable application fee on each one of these. It's grain storage facilities. We're going to look at what you need to store for 2 years on a projected harvest for a specific grain crop. Eligible equipment includes newer used storage structures, grain handling systems, dryers, electrical, and more. And we can do some renovation of existing storage, may qualify. Some of the recent changes and what we added to that, we can use newer used portable equipment, handling trucks. That includes bulk tanks, conveyors, augers, vacuums, portable scales, grain carts, trucks. I made a couple loans on auger carts, and I just recently made a loan on a semi truck, which was kind of an interesting one. So most of our commodities, of course, we're looking at corn and beans and wheat around here. We don't have any of the added ones in there. So next slide. This next slide is what makes this very appealing to a lot of producers. We have term lengths here. For a microloan, we can go from 3 to 5 years. 100,000, we can go up to 7 years. 100,000, 250 is that 7 to 10, and up to 500,000, we go 7, 10, or 12 years. Anytime we go over 100,000, we are going to take real estate as a mortgage as a security. So some guys will keep it at $99,999, and that's just fine. So this last part here are interest rates. That's what makes this very appealing. So you look at a 5-year 0.375% interest rate or a 7-year 0.625% interest rate, you're just like, why not? Well, just like any other government program, there's a lot of paperwork involved in these. So to get that lower interest rate, I'm just going to tell you, you're going to have to go through a lot of paperwork, but I do help you every bit along the way. I've had a lot of interest in these loans here lately and have been very busy with it. Interest rates have gone up. That semi truck, I believe I think it was a 5-year loan. It was only 0.25%. And I think that was in October. So we've gone up a little bit. We're at 0.375 now, but that's still a very appealing interest rate there. If it is a grain bin, anything that would require any type of land disturbance, there does have to be an environmental assessment done. We have a team in the state that do those. So you can't do any type of land preparation, no pouring the concrete until that gets done. And that normally takes 45 days. So a lot of times these take a little bit longer to happen. But if you're patient and can wait that time, that's a good thing. So I've had a couple guys have applied for a loan. They aren't planning on putting it up till this summer, but they understood they need to get that environmental assessment. So they've already applied for it and we've sent those folders off. Next slide. So we have marketing assistance loans because historically at harvest, grain's going to be at its lowest. And that's when the producers are needing to pay their cash rents. They're their landowners and they have other bills that are coming out. So they need to have some cash flow. And that's one of the things we can do with these market assistance loans, MLA loans. They're available as soon as harvest begins, and they can run through March 31st for wheat, and the application for corn and beans is May 31st. So the producers just self-certify what they have out there in the bin. We do have it, county committee comes up with a reasonable yield. So if a producer tries to tell us they're getting 300 bushel to the acre and they want to get that many bushels of corn or beans under loan, we're not going to let them go that high. We make it reasonable. We do perform a lien search and we do a UCC on that grain. All these loans are subject to spot check. Every month we go out there and do some routine spot checks. So we are going to make sure our grain is still out there. So when the producer's ready to maybe haul that in January, February, or March, he just calls up and says, hey, I'm going to be hauling it to ABC Elevator, and we'll send that ABC Elevator a release saying, hey, this grain here is with us. It is under loan. Make sure you put our name on that check. So a lot of times they'll call for a payoff and we'll give them the amount of just that check of those bushels. Next slide. So our interest rate does change monthly. The current interest rate for January is 1.125% for these loans. They do mature 9 months after the end of the calendar month in which they were approved. And for 2020, because of the COVID problems, they are letting the producers go to a 12-month loan. The producer can repay the outstanding commodity loan at any time without any penalty before the maturity date. And here are our loan rates in Randolph County and Wayne County. It's a kind of an interesting program. We do get I think we have about 20, 25 producers that use these each year. So it's a nice way of being able to get some money to pay the bills when they're coming due. Next slide. Farm changes. And I think this is something that Chris Peacock can tell you that we take very serious in here is any privacy on that. So it's one of the big things that we do in here, all of our offices do. And what we're looking at for privacy, the things that are under the Privacy Act are farm numbers, acreage, FSA maps, basin yield information, highly erodible and wetland certification information is also under the Privacy Act. We do not release this information to anyone other than the owner or operator on the farm, but we do require the owner's permission in writing to provide it to anybody else before we can share that information. So I think Chris has got some sort of standard language that I know he's sent out to people that we can do that. So we have to know what we can release, who we can release it to, very specific on that. So if you are going to be maybe selling your farm or you are going to be putting it up for rent out there for contract, you'll need to let us know that, because maybe you want to say anybody that wants to find out they can, or you only want to provide that information to certain people. But we do not share information without your permission on that. It's very, very particular. We could get in a lot of trouble for that. So we take that very seriously on there. So one of the things that you need to let us know as quickly as possible is if you're adding or changing an owner on a farm. Just always surprised that the ownership changes. Maybe tell us, hey, that I'm going to be buying this farm, or I'm in the process of doing it. Let us know. It kind of helps us make sure that, we kind of put a little flag on there. We're looking for that deed as it comes in. Also, if you're going to be adding or taking an operator off the farm, make sure you let us know. And normally we're going to want to have that in writing, but if you can call up, we can do a lot of our business by email too. Call us up, let us know. We can get that farm flagged on there so that we make sure that somebody else doesn't come in and sign it up that we didn't know about that. Next slide. Okay, an 80-10-26. An 80-10-26 is the highly erodible and wetland conservation provisions. So anybody that gets one of our payments has to sign one of these certifications that they are in compliance with these two programs. And if somebody does violate the highly erodible and wetland provisions, we always called it sod buster, swamp buster is another way of using it for this form. But if you do, you could be ineligible for our programs. So this could include just clearing a fence row could make you, that could maybe considered a wetland, and you could lose your payments on that, our provisions on there. Next slide. So who needs to file a 1026? And this is one of the things that Chris was asking me for, and it just comes straight off the form. And it says a producer who has or will plant an agricultural commodity on any land for which a highly erodible determination has not been made. So if you've got a permanent pasture out there, you're thinking about plowing up and planting, always come in and get a determination on that. It's probably not going to be a wetland, but it could be highly erodible, and we might need to get a conservation plan on that. The second bullet here, if anyone has or will perform any activities to create new drainage systems, conduct land leveling, filling, dredging, land clearing, excavation has not been evaluated by NRCS. And this includes clearing any trees or any fence rows or trees. So I always tell somebody, I'm not an expert. I can't tell if that fence row is a wetland. It sure doesn't look like one, but you know what? I'm not that technical expert. NRCS is. And the only way you're going to find out is if you file a 1026. And I suggest that to anybody. Always file that. I had somebody that was going to fill some stuff. Now right there, that word in there says filling. It doesn't matter. Always get these things checked, because you sure wouldn't want to jeopardize your payments in our office for something like that. I'm not that expert. NRCS is. We would suggest that you don't wait, and this happens quite often, that the bulldozer is out there in the driveway, the guy's wanting to take out the trees right then. Don't wait till then. Let us know a little bit ahead of time. They can't get these done immediately. They are a lot quicker than they used to be, but it does take a little bit of time to get that done. So you fill out one of these 1026s, we're going to send it over to NRCS, our sister agency across the hall. They have some technical experts that will work on those and get those out. Now, Chris did ask me who gets notified of these. So I went over across the hall and asked Randy, our district conservationist, and this is just here in Randolph County. He says the person who filed the request for determination will get a certified letter with that. But all owners and operators on the farm should also receive a notification of the determination. So I don't know if that happens in all counties, but I know here in Randolph County, that is what Randy told me that they do over there. So just keep that in mind. Maybe you don't get a copy. You can always come into NRCS or FSA and we can get a copy of it if you are the owner or operator on that farm. Next slide. We have a farm loan program. I already talked about a couple loans that our FSA county offices take care of, but we have a farm loan office in Henry County. Kimberly Wurtzball is the farm loan manager there that actually has a lot of different loans and financing options available out there. There's like direct loans, guaranteed loans. We have beginning farmer loans, youth loans. We've made loans to kids that are 15 years old for their 4-H animal. I think the terminology we use for FSA in lending is that we're the lender of the first opportunity. So if you can get lending someplace else, most likely you won't qualify for this. So these are for people that maybe can't get lending someplace else. A beginning farmer, it's hard for a bank to go out there and give a beginning farmer a loan out there, but we can do that at a pretty good interest rate out there too. So if you have any questions, I would suggest contacting one of our farm loan office up there. You can also contact me and I can put you in touch with them. The next slide, COVID restrictions. Due to the elevated rates of COVID spread, we are not allowing any visitors in our office. It's very difficult when we're looking at a high volume of sign up and everything that we're looking at hitting before March 15th. So we're looking for producers through email, phone, box signatures. It's a way of getting a signature on a document. Microsoft Teams, it's a lot like your Zoom, but it's Microsoft Teams. We do have restrictions on the number of employees that can be in our office at one time, but we have tools to take care of everyone from wherever we are. So with the limited employees in our office, we ask if you do call and we don't answer, please just leave a message. We're going to return your call as soon as possible. It could be an instance that I'm on a meeting like this and I'm only allowed 2 people in the office. My other program technician's on the phone and the phone's ringing off the hook, which it was like that all morning long this morning. So don't call back 10 times. That's happened before too. If you just call, leave a message, the employees that are working from home will see that message and will get you called back. We always make sure that we get everyone called back very quickly on there. I think Chris also asked me about cover crops. One of the things that our NRCS office does is cover crops. That is not something that we work within over here at Farm Service Agency, but NRCS does. I know they have cost sharing on them. I've seen many demonstrations on the value of cover crops. So I would suggest if you have any interest in cover crops, you could contact Randy Maggard over at our Natural Resources and Conservation Service across the hall. He could provide you some information on that. And lastly, with the change in politics, normally you're not going to see a change here in me sitting here in this office, but our state director and our state committee are political appointees. So when the hand goes up tomorrow, they will resign. So that's usually they're out the door at noon on the day of inauguration. So it takes a while before we can get our new state director. Also, the Secretary of Agriculture, and there's many political appointees out in Washington, D.C. They're the same way. When the hand goes up, they have to walk out. So it will start with the Secretary of Agriculture being appointed and being confirmed first, and then everything will trickle down to our offices. But normally that will take probably, I think last time we got our new state director in end of October. So it takes a little bit of time. Now, our state committee is also a political appointee, but they allow the state committees to stay on. So they'll be kind of providing some continuity in that time in there. So they will, until that new committee does come on later on, they will still stay in office. So if you have any questions, I think my slide was up there with my information that was on there. You can call me at either office. I do split my time between the 2 offices. My email's also up there. You can also email me any questions. And I don't know if they have any questions for me now.
Nancy, thanks so much. No, I'm not seeing any questions for you at this point. Let's see, my screen just changed. And I did have a couple of questions. One, Mr. Bogle asked me related to, how will, gosh, I got a lot of questions and I'm not able to find them. The first question was really about the impact of solar leases, wind leases, those kind of things on farmland values. And a lot of times that is just the income of those leases capitalized into the value of the land. So in other words, a wind turbine might add $600 to $800 an acre on an 80-acre parcel in our experience. Solar could add a lot more because you're renting the land at a per acre price for a much higher value. So haven't seen any of the solar fields transfer yet or sell. So until we see some of that, we won't really know what the outcome will be. Same with billboards, cell towers, those kind of things. That's an income stream. It's $800 a month, $1,000 a month. And if you capitalize that, you use a discount rate. So maybe it's 5% or 6%, and you divide that income by that. And that can really be a factor that you'll see add value to a property accordingly. There was a question, how will Bill Gates buying so much land affect availability for you and me? Well, I think that's in reference to the article that just came out in the last week or so by the Land Report. I think if you read that article, Mr. Gates acquired that land over the last probably 13, 14 years. And so has it affected availability of land for you at this point in time would be my question. That percentage, that land that he owns is all over the United States. Same with Ted Turner, same with those other large landowners in the Land Report. A lot of it is ranch land or big blocks. And so it's not really affecting availability of land here in the Midwest. And one of the reasons I showed that chart earlier of the percentage of farmland ownership and who's buying farms today, I really want to make the point, most of the farms we're selling are bought by our farmers. And so it really hasn't affected availability of land. It does affect price a little bit, but it's a pretty small percentage. Investors do exist out there, but they're not predominant buyer. Scrolling on down now, so bear with me. Adding, answer those. Yeah, so how would the potential elimination of the 1031 exchanges, which is one of the Biden proposals, affect land values? And then also what would happen if the estate tax is reduced from 11 million per person down to something less? In this case, the question is $4 million. And that might be, anything over that would be subject to the 40% taxation. And that's not compatible with passing on the farms to our heirs. I would agree. So the first question is, how would a change in 1031 exchange taxes impact, or that rule impact farmland values? Well, if they eliminated the 1031 exchange as a loophole, that would reduce demand because you would have sellers of highly appreciated real estate that in the past have sold for a subdivision around Indianapolis, and then they want to trade it for land in Wayne County. That no longer would be an advantage, a tax advantage to do that. So that would create some less competition, less impact upward on farmland values by elimination of that loophole. More concerning to me would be the capital gains tax. Just if they increase it from 20 or 22% that it is today, if they made it equivalent to your income tax rate, think about it. When you might say, well, I'm in a low income tax bracket, that won't affect me. The year that you sell the farm, all of that income would dump into your income equation for your income tax return, and you may be bumped up into a much higher tax bracket. So you could see tax brackets in the 30s. So all of a sudden your capital gains tax goes from 20% on the gain to 30-some% on the whole. That would have a very negative impact on farmland and maybe people not even wanting to sell it at that point in time because of that tax. Now, the estate tax question is another good one. If right now, if you got 11 million of coverage for your spouse and 11 million for you, that's $22 million. That covers a lot of farmland that's owned out there. But if all of a sudden that got reduced down to 3.5 million or 5 million per entity, that starts to catch a lot more farm families. And that's a really good question, that if it's, all of a sudden everything over that is taxable as an estate at a 40% or a higher level, that does hurt passing that farm on to your heirs. So what do you do about that? That brings back to the need for estate planning. And then how do you start to set up entities that own the farmland that you can start passing value and getting it out of my generation's estate into my kids' generation or my grandchildren's generation. So that really hasn't been a big concern in the last 5 or 6 years because of the high estate tax coverage that we've had. But if that changes back to a lower level, that really comes back into play, especially with the high land values that we have today. So I think that's something to definitely keep your eye on. The other one that was concerning to me, there was a talked about briefly, I don't know that it would ever happen, but a mark to the market capital gains, meaning they would mark your assets to the market today and could tax you on the gain up at that point. I doubt that happens. That would break a lot of people in a lot of different industries. So I just don't see that one happening. So a lot of proposals out there. Absolutely nothing has been proposed yet in the House or the Senate because they don't start really until tomorrow or Thursday. And so it just bears watching, what gets talked about. How can you impact legislation? You have the opportunity to talk to your senators. You have the opportunity to talk to representatives and give your opinion. So I would encourage you to do so as these things start to get discussed. You may say, well, Howard, I'm in a Republican state and my representative and senators are Republicans, and that's really not going to have an impact. Well, you might provide the senators the reason why they're voting and maintaining that 50-50 split on some issue. And then it becomes a negotiating item in Senate or in the House of Representatives. So I do always encourage you to speak to your representatives, reach out to them via email and pass on your opinions and how this might impact you, whatever that legislation might be. So those are some thoughts on taxes. I think that's probably the biggest impact on farmland in the next 6 to 12 months is what kind of tax law changes come about. Nancy, thank you so much. That's a ton of programs you guys have, and you've done amazing work. Because I know nobody's coming into the office. You got to do it all by phone. You got to dig files out. It would be very challenging to do. And then you've had program after program after program get announced. And oh, by the way, Nancy, just take care of it. And that's kind of the way it's been. So we really appreciate all the work that the FSA does. Obviously, both on the program side as well as the NRCS side. It really is a tremendous benefit to farmland in general. So thank you for your work and thank you for your presentation today. Nolan, you can't see the questions, can you? Okay, did we have any others that I'm missing? Okay. All right, well, we're ready to wrap up unless there are more questions. So if you have some, the chat is still open and you can shoot those questions to us. If not, we will go ahead and send you on your way for the rest of your afternoon. Again, thank you for joining us. Thank you to Nancy and the Farm Service Agency for your presentation today. And we just appreciate your interest in farmland. And if you have any questions about your specific farm, that's one of the things about farmland is every farm is unique and different. And you can use these general average numbers that I just shared with you and say, well, my farm's worth X per acre because Howard showed me this chart that said it was worth $50 a whoppy bushel, maybe. Every farm is different, every location is different. And that's why we have experts that can help you. And if you say, hey, I want to know what my farm in Randolph County is worth, Chris or Lauren are the people to reach out to and ask. So with that, we'll turn it off for today. Thank you all for joining us. And we do have another seminar, I think, Nolan, coming up in Lafayette. That'll be another virtual event. So not really in Lafayette, but we're doing that in conjunction with Farm Credit Services over there. So you can look on our website or in our blog for that date. And then if you have other people who want to join and hear the update at that point. So with that, we'll sign off. Thank you all for joining us and have a great afternoon. Bye, everybody.
Thank you, everyone.